decided that let's start a small initiative, a drive where we can bring in basic financial literacy. No complex jargon, no complex talks. We'll keep it very simple. How to manage your finances. So ఇందులో కాన్సెప్ట్ ఏంటంటే సార్ చాలా సింపుల్ అంత కాన్సెప్ట్. టీచింగ్ ఏ 10-year-old అనుకోండి మీరు ఇందాక. జస్ట్ ఇమాజిన్ దట్ దేర్ ఇస్ అ 10-year-old బాయ్ సిట్టింగ్ ఇన్ ఫ్రంట్ ఆఫ్ యూ అండ్ యూర్ గోయింగ్ టు టీచ్ హిమ్ హౌ టు మేనేజ్ యువర్ ఫైనాన్సెస్. ఆ లెవెల్లో బేసిక్ టీచింగ్ ఇస్తాం సార్. We don't promote any particular fund or stock. We don't promote any particular insurance company. We just sir. Raju sir, the voice.
లేదు ఉన్నారు ఆయన మళ్ళీ మ్యూట్ చేసుకున్నారు. He's muted himself.
Okay. నేను ఆయన్ని పిన్ చేస్తున్నాను.
Are you the host? Can you do that?
Yeah. I think now I have unmuted him. So, meanwhile, I'll welcome all to our IAP Vizag's Wealthy Wednesday series. Thank you so much, Bangaru sir, Narasimha Rao sir, Madhavi madam, Murli Mohan sir, Prashant sir, Pratap sir, Preeti madam, Poddar sir, my mentor Poddar sir is also here in this meeting, Vidya Sagar, Shivkumar sir, Samuel and others who have joined today. I am thankful to each one of you for joining this enthusiastic event, Wealthy Wednesday series. So every week we discuss one topic on investing and finances. And I thank my team who have been relentlessly on the back end supporting me, my interns, Hemashri, Varsha, Supriya, Zaid and others. So after this starting, let me invite our very respectable Murli Mohan sir, who is a professor in Geetam Institute, who is now a secretary for our IMA Vizag. He is actually a very busy person, but despite being busy, he accepted our invitation to discuss some basics of.
This meeting is being recorded.
So he agreed to discuss some basics of financial fitness. In this series, today we are going to discuss how to build a simple strategy for retiring comfortably without having lakhs and lakhs, with few thousands, how we can draw a pension of lakhs and lakhs after retirement. Sir is a very senior member, has taught many people in his lifetime, has been a great mentor and teacher. And today, Sir is going to take a small few sessions on how to retire comfortably. Murli Mohan sir, over to you.
Thank you, Satish. Can you share the screen?
Yes, sir. I am doing that in 1 second. So, Murli Mohan sir, yes sir, over to you sir.
A very good evening to members of Indian Academy of Pediatrics. I warmly welcome you all on behalf of our Indian Medical Association Visakhapatnam branch. Satish, next slide please.
Yes sir.
Satish, next slide.
Next slide Rana sir. Sir, మీకు నా స్క్రీన్ కనిపిస్తుందా సార్? ఐఎమ్ ఆన్ ద సెకండ్ స్లైడ్.
సార్ ది నెట్ కట్ అయినట్టుంది.
ఓకే, విల్ ట్రై వన్స్ అగైన్. 1 second.
Recording has stopped.
Yeah, now you're audible, sir.
Okay. Yeah, you make it full screen, please.
Yeah.
Next slide, please. Yeah. Now we are going to discuss about retirement, post-retirement plans. Retirement calculator, know your future needs. The basic needs of a human being, it requires minimum 50,000 per month. We need this much of amount as monthly pension after retirement. Since the retirement age is 60 for many of the employees, post-retirement life will be for 25 years as the lifespan have increased to 75 to 85. Now, if you need 50,000 per month in 12 months in a year and in 25 years, you have to secure 1.5 crore in which inflation is adjusted. Use calculators to compute corpus and SIP needed. Satish, can you click the retirement calendar?
Yes, sir. I'm just coming to it, sir. So this is a calculator, sir. I'm assuming that I'm current 25 years, retiring at 65 years, living at 85 years. I have taken here, yeah, my monthly expense to be 50,000,
Yes.
inflation 6%, pre-retirement, my rate of return is 14%, and post-retirement, my fund will grow at 10%. So
Yes.
here's your amount, sir. So this is the amount required for SIP. Yes, sir. Over to you, sir.
If you want to get 50,000 rupees per month as a retirement pension, you have to invest at the earliest. Satish, next slide, please.
Yes, sir.
Yeah. Start early, retire happily. This is the best slogan. If you invest early, it gives the advantage of compounding. Compound interest multiplies wealth over time. Even small monthly amounts can grow significantly over 35 years. Smaller investments grow big over 30 to 35 years. Early starters enjoy high returns with lower risk. Early starters can invest less but earn more. Quote, it is not about how much you invest, but how long you invest. This tells us if you start investing at a later age means after 40, 45 years, your investment capacity will be there only up to 15 to 20 years only. Then your investment must be more than what a 25-year-old person invests. So, if you invest at the earliest, you will be the better person. Happy versus late investor. Who wins? Happy boy start at the age of 25 years. He invests 25,000 per month for 35 years. It accumulates to 1.14 crore. Late investor, he starts at the age of 45 years, 45,000 per month, and he invests only for 15 years. It accumulates to 0.74 crore. Hence, what we see in this table is early start, small amount, high return. Late start, large amount, lower return. You see the faces of the two persons in the slide. Early start, small amount, high return. He is very comfortable, very happy. Late start, large amount, lower return. He is not comfortable. He is having agony. So this next slide, please. For example, if a person starts his investment, a happy boy, at the age of 25 years, his monthly investment will be only 2,500 rupees. He invests for a period of 35 years. Expected corpus at the rate of 12% per annum. 1.14 crore. Unhappy boy, the second person, he starts investing at the age of 45. He makes his investment, monthly investment at 45,000, and he can only invest for 15 years. And it will, the expected corpus is 0.74 crore. Happy boy retires peacefully with a lower burden. Late man struggles to catch up. In this regard, I would like to tell one of my personal experience. So we never started investing. Then what happened at the age of 50, 55 only, I have started investing in purchasing a flat, purchasing a site like that, which didn't yield much good returns to me. Satish, next slide, please. Yeah, time and money required. If you want to invest, you require money. At the same time, the investment period also is more important. So time is also more important. One who starts early at the age of 25 years, he starts with investment of 2,500 per month for a period of 35 years for 50,000 retirement pension after 60 years. And late starters, that is 45-year-old, he invests 45,000 per month for 15 years to get 50,000 per month. Time is the biggest multiplier for investment. If you invest 1 rupee today, it becomes 100 rupees after 3 months. If you invest 1 rupee after 3 months, it will be there as 1 rupee only. A 25-year-old boy and a 45-year-old boy, time is the biggest multiplier for investment. So this next slide. This is the monthly savings required for 50,000 pension. This table shows that if you start your investment at 25, 30, 35, 40, 45, your monthly installment will be more. The period you pay for the investment will be much less. To get the secured corpus fund, 1.14 lakh, 14 crore. So start early, invest small, and retire 10. If you want a pension of 50,000 per month, corpus needs to be 1.5 crore. The return after retirement is 6%. So this next slide, please.
That's it, sir. That's the last one, sir.
Okay, right now.
So essentially, so you're trying to say that start early, invest small, and sleep peacefully. Correct, sir?
Yes, 100% correct.
So thank you so very much, sir. Thank you so very much for impressing a point that time is the best tool you can utilize to retire. On your example, sir, I would like to share one of my examples. My mentor used to always tell me, Satish, out of the four parts of your life, the childhood, the young age, the middle age, and the old age,
Yes.
the weakest part, the most fragile part of your life is the retired life. Young age low,
That is old. Yes.
yes, sir. So, yeah, go on, sir. You're saying something. Murli, sir. To you, sir.
Ah, yeah. You see, if it is in the childhood, your parents will support you. Even in the adult period also, your family, your other family members, they will support you. Once you enter into the phase of retirement at the age of 60, you are more fragile. Children will fly away on their own responsibilities, and you will be left with your own responsibility, and your health, your body, everything will deteriorate, and you need a lot of support. So, a minimum of sum of 50,000 per month is required as pension for you. So, you better invest at the earliest, and you be calm at the age of 60. That's what I want to say.
Thank you, sir. Thank you so very much, sir. As sir very appropriately mentioned, the most weakest part of your life is your old age. So, my dear friends, the first penny you save should be not for your happy homes in middle age or big cars or big companies in middle age or young age. Retire first penny as per this calculation. If you are earning 35-40,000 at the early age of 25 years, hardly 5% of your salary, 2,500. If you save, you can create a comfortable corpus better than your current existing life. So please, I want to impress this point again. The first penny and the earliest years, you should start saving for retirements. Thank you, Murli Mohan sir. Thank you heartfully. Thank you a lot for taking out your time from your busy schedule and accepting the invitation from IIP Vizag. I'm looking forward
Yeah,
to
welcome.
IIP and IMA collaborating in taking this drive further, sir.
Yes, yes, we'll do it. We'll do it.
Thank you, sir. Thank you so very much. Now, our very good friend Raju will tell us that sir has mentioned that from 1.5 crores at a basic FD rate of 6%, how one can create 50,000 salary income pension every month. But our remarkable Raju has got better plans. So I welcome our president of IAP, our remarkable Raju. How can we make slightly higher, slightly higher returns or higher pension from the same 1.5 crores? To the young budding investors who are new to IAP or from people who are from IMA, I would like to introduce to you our dear SBAS Raju Kakarlapuri. It's a big name. Just like big people have big fame and big aura around them, the big name. We fondly call him Remarkable Raju. Why do we call him so? Because any academic question, any tough learning curve, any tough complex junctions, we always look forward to our academically strong and remarkable Raju. Not only that, he's a very hardworking, very honest, and a very helpful, supportive colleague as a pediatrician. If I were younger than him, I would look upon to become, wow, something like Raju have to grow up and become. So welcome heartfully, Dr. Raju. Today we are going to hear from you. How can we manage the retirement corpus in a smart way?
Thank you, Satish sir. Thank you for this very warm and rather undeserving compliments. Thank you so much, Murli Mohan sir Chepnattu. Let us assume that worked, you have worked your entire life. You have saved for your retirement. You have come to a stage where, like, ఇప్పుడు నా వయసు 60 ఏళ్ళు అనుకోండి. Like, if I am at that uh, retirement age, what do I do with the money that I have? I have a estimated corpus. What should we take as a corpus, Dr. Satish? ఏం తీసుకుందాం?
1.5 crores, Andy.
Let us assume that with your hard-earned savings, you have put every month in your whatever you have invested, and you have achieved this amount of 1.5 uh, crore. So, like, one few points which sir already has, I'll slightly uh, uh, tell about that again. Earlier the better. Start early for your better corpus. Start late, lesser the corpus. So, when you are having that amount at your retirement age, let us assume that Uh, you have, how do I put this? Can you go to the next slide? So we will be discussing about how to get better returns from the corpus that has been created uh, with the already invested amount in the past many years. As an adult, working adult, you have invested some money, and that has come as a corpus to you at 65 to 68 years of life. What do you do with it? How do you make it much more helpful for you? A very wise man once said, and it has stuck to me forever with that line: do not work for money, let the money work for you. The money should work for you. So we are all in an endless loop. We are working for money, we are working for money, we are working day in and day out, neglecting families, we're neglecting our health, we're neglecting our time. But what we have been, I'm not saying it is a mistake, but it is in the constant loop that we are working for money. We should let money work for us. That is what Dr. Satish has been tirelessly trying to help you all, to teach you all, that let money work for you. So in that case, now you are already done. Your discipline is there. You have invested that amount. So how do you split your retirement money? Like for example, you have that. You have to have monthly income, right? You're not working. You should have monthly income. What do you do? Do you put that entire money in an FD? How many of you say yes? Can somebody put your answers in the chat box? How many say that it's a safe option because after 60 you don't want to take any risks? Okay. In your chat box, please say yes or no. What if you have this corpus amount at 60, 65 years of age? What do you want to do with that money? Do you want to what do you want to do with that money? So Praveen Verma says no. Anybody else has any differing opinion? Anybody who wants to say yes because you don't want to take any risk. So I'll put my entire money in your fixed deposit. So it will give us 6% return. I'm very poor in mathematics. Dr. Satish, can you help me? If you put a 1.5 crore in FD, assuming that after 30 years from now, the returns are still 5.5 to 6%, which I'm sure they might come down in the future. But let us assume on the positive side that you're getting 5 to 6% returns. How much will you get, sir, monthly? How much will you get if I put the
Approximately
entire?
50 to 60,000, Raju. At 5%, you get
So
approximately 60,
you
70,000.
have so much amount of corpus. You're putting that entire money into a fixed deposit. According to current norms, which is not going to be the norm then you will get approximately 50,000 is what the calculation is.
And that too,
With
they will be taxable. So you have to
they're
pay
taxable.
taxes.
Yeah, yeah. So 50,000 at an age of, you can imagine what I'm trying to say, right? It doesn't add up for a comfortable life because, like Sir said, Murli Mohan Sir said, you will require at least an amount of 1 lakh to have a decent, stress-free life. So, if not FD, can anybody mention what do you want to do in the chat box? What do you want to do? Can we go to next slide? 1 lakh to have a decent, stress-free life. So, if not FD, can anybody mention what do you want to do in the chat box? What do you want to do? Can we go to next slide?
I'll put in stocks. I'll put in
Dr.
funds.
Satish wants to put in stocks because he is the stock man. He will say, I'll put in stocks. Can anybody say anything else? Does anybody wants to oppose? Please feel free to communicate. Sir says he'll put in stocks. Anybody else has anything else to offer? Does anybody want to do anything? Okay, somebody said from VM says SIP bar gold. Wonderful. Somebody said hybrid funds. So let me tell you this. Longer the duration, significant the return. Shorter duration, uh, the lesser returns. So what every human being wants. I want returns, but I want less risk. Isn't it all we want? So everybody in their mind they're saying no, but majority of the people who are attending this workshop know that FD is the safest because it is a debt fund, liquid fund. There is no risk. మార్కెట్ ఏమైపోయినా పర్లేదు వరల్డ్ వార్ ఏమైనా పర్లేదు మీ 6% మీకు వచ్చేస్తుంది బట్ దట్ ఈస్ నాట్ వాట్ యూ హ్యావ్ వర్క్డ్ హార్డ్ ఆల్ దిస్ టైమ్ సో అవుట్ ఆఫ్ something is wrong. Shall I continue?
Yeah, you can continue.
Yeah. So out of the fund that you have, it is never only mutual fund. It is never uh, only what do I say? Fixed deposit. It's not only gold. You have to have this What is that thing called, sir? It is a box of four. What is that rule called as?
Four basket rule.
Four basket rule. Four basket rule. We will talk about the four basket rule. Can we go to that slide where we can explain the four basket rule?
I will open this thing, Raju, for you. Yeah.
So we are having we not we every human being knows that as long as you're alive, there will be inflation. That is, your cost of living will keep on going every year. Current estimated inflation is somewhere around 5.6%. It's somewhere between 5 to 6%. So you can't. You want a pension of around 1 lakh per month. So per year you want 12 lakhs. Isn't it right, Satish sir?
Yes. So I want,
Yes.
I am not happy with 50,000. I want 1 lakh from the same 1.5 crores. But I want
Yeah.
to be very safe. I don't want to take any risk.
Yes. So you want to be safe. You want to have not to have risk, but you want the returns also to be more. So in that case, let us assume that your time left after retirement, assuming it to be 30 years, and with a returns of around 15%. Why he said 15%, we'll discuss later. For that, how much do we invest every monthly SIP? It's around 3,000 rupees. Isn't it a very less number? It is a very small number. So, or you can do a lump sum required. You can invest approximately 2.65 according to the calculator that is here. You need to invest around 2.65 lakhs, a lump sum amount at one time. After which, at the time of 68 years, kindly come down slightly on the chart, you will have a corpus of 1.75 crore rupees. Okay. So adjusting the inflation and returns that it is mentioned, the pension withdrawn 1 lakh. So 12 lakh per year. Isn't that right? So
Yes.
in each 12 lakh, see, look at the money is coming down. Pension withdrawn, the money is coming down there. I can't see it from here. Sir, can you just continue
Raju, can
this?
you please repeat that?
సార్ ఇప్పుడు మన కార్పస్ ఉంది కదా సార్, దాని మీద వీఆర్ గెటింగ్ 12 lakh. ఫస్ట్ ఇయర్ 68 to 69 years మేము 12 lakh తీసేశారు. మీ అమౌంట్ నుంచి 12 lakh తీసేశారు. యూ డు నాట్ హ్యావ్ దట్ 12 lakh ఇన్ యోర్స్ ఎనీమోర్. ఉదయ్ సార్, ఆర్ యూ విత్ మీ?
Yeah.
Yeah. So look at that amount to be allocated. It is coming down. Okay. It keeps coming down every year. Okay. So what we're planning to do is you do a conservative hybrid, balanced hybrid, and aggressive hybrid as the age progresses. I want to talk like, how do I put this? First 3 years, you put your funds in debt fund. Dr. Satish sir, please correct me if I'm wrong at any given point.
Yes.
Okay. In the first 3 years, invest your amount in the debt funds. You know what are the debt funds? The simple ones, the
FD like
fixed
funds.
deposit, FD like funds where you do not have risk. Okay. From 4 to 6 years, you can go for hybrid funds. Hybrid funds and the parallel on the hybrid. It's a mixture of debt plus equity. Half of your amount you will invest in debt. Half of your amount you will invest in equity. After 7 to 10 years, shift to entirely to equity. Am I wrong here, Satish sir?
No, you are absolutely right. I would just add a small point here. Here in this chart, you can see conservative hybrid, which is almost 80% debt, 10% equity. Balanced hybrid is 50% debt, 50% equity. Aggressive is 85% equity, 15% debt, and mutual funds are 100% equity. So these are hybrid funds with, as you go down, they have higher allocation for equity funds. As you go earlier, they have higher allocation for debt.
So somebody has a doubt, why can't you keep SIP at systemic withdrawal plan at 68 years of age? That's a very good question, actually.
And
Please answer it, sir.
Shall I take it? Yeah. So this is a kind of SWP panel, sir. So here you can see that you are withdrawing this much amount of money. First year you withdrew 12 lakhs. Next year you withdrew 12.67 lakhs. Then 13.37 lakh, 14 lakhs, 14.8, 15 lakhs. You are systematically withdrawing. The problem with SWP having only one fund is If you choose any one of the funds, not a basket, you are having a disproportionate risk reward ratio. By having this basket and having a HWP, you are making the most of returns and the lowest of the risks. As Raju said very well, the risk here is in all the funds is close to zero. So why I'm saying zero? Because these funds beyond a specific amount of time have a very low risk, zero or hardly 1% risk. So debt funds in the first 3 years, they will have very low risk. Equity funds or aggressive funds above 5 years, although they are very risky, but with the increasing time, the risk comes down. If you choose only one HWP plan, like conservative hybrid, then you are compromising on returns. It will again sit at 6 to 7%, as you can see here. And if you sit only in mutual funds, equity funds, aggressive funds, you're sitting at very high risk from the day one of the investment. So you are right, HWP is best, but the second half of question is HWP into what? So as you can see here, Raju is trying to tell us HWP into what we are going to discuss today. Okay, Raju, over to you.
Yes. So the if I have to take an average like the first 1 crore in the 5 years to invest in the debt funds. Debt funds are your fixed deposit, your liquid fund, which means you can do this overnight funds can be taken without lock-in period, which is also a bond fund. Can we talk about the bond funds now?
Yes.
And
So
just put yeah, what we're trying to say is in the first 1 crore in the 5 years, do the short-term funds. It can be those overnight funds, liquid funds, ultra short term, medium, or those long term funds. The second 1 crore in that 5 to 10 years, use that in your mutual funds. Because after 5 years, there are no, literally, can I say, I should not say compulsory, there is literally no negative returns after 5 years. So please do invest in that equity funds. The longer the duration, significant the return. That's what we have been trying to say all the time. And one thing what we want to say is any debt fund, either be it long term or short term. I'll put FD for 10 years. I'll do this debt fund for 5 years. Any debt fund which is long or short, you cannot cross and return of 9 to 10%. Am I right, Satish sir, in this?
yes, so
Yeah.
I would like to just add one point here. So you can take the funds into three categories: debt, hybrid, and equity. Just saying 12 to 15% has been the best return. So we won't take more than that. Not that we won't cross it, but very less likelihood. As you said, less probability. Most likely probability will end up in somewhere in 12 to 14%. For debt funds, very likelihood you will end up somewhere in 6 to 7%. For hybrid,
Not
9
more
to
than
10%.
not more
No,
than 9%.
no. Yes, you're right. So over to you, Raju. Go on.
Oh, see that's what rather than splitting in years, why cannot split total corpus at 68 years of age?
Okay. So you are saying that your question is whether we can invest or break all the things in 68 years, right?
No, at 68 years. At 68 years
Ah,
of life.
at 60 years of life? Sorry, I didn't get a question.
Yeah, Satish, sir, this is my question. Rather than like 3 years, 5 years, rather than postponing 1.5 year, why can't you divide 1.5 year at 68 years into FD, mutual funds, high risk funds? Amount, why can't you split?
I agree with you, Ramesh, that we can do that as well. So in the uh, sorry, I would like to ask you to repeat a question. You are saying that at 68 years, break into three box, or you are saying
Yes, break
No,
into
no,
four
he's saying
boxes. Sir. That 1.5 year, break into four boxes, we can continue for long years. As the long years, the risk will be less. As you're telling that, no, after 5 years, the high risk is less. If you split at 68 years, the risk will be 12 years, it will be almost zero.
correct? Correct. Agreed. So you are right, Raju. You are right, Ramesh. So at 68th year only, we are going to break it. Break this 1.7 crore, as you can see here, 1.5 crores into 4 blocks. Each block will be approximately 40 lakhs. 140 lakhs will be into this conservative entities, which you will eat up in the next 5 years. Next 40 lakhs will go into this block, balanced and aggressive. The last 40 lakhs you can put into equity funds, stocks, or whatever you're okay with, because as you know, in the longer run, the last 40 lakhs ka block will stay for 12 years. It will have almost zero return, zero risk in the long run. I agree with that point. You can break it up at the beginning only. What I would like to impress upon you today is, just look at this one chart here. As the time increases up to 85 years, your corpus is going to diminish to zero, because this planning is meant for 85 years. In FD, what people miss out is the principal remains same, and
That's the interest rate.
they withdraw only interest money. That's why they need a higher corpus to sustain the
To
retired life.
get better interest.
Yeah, so what we would prefer to do is some part of interest, mostly interest, and some part of principal. You will consume, eat up slowly. And in this way, by 85 years, you would have eaten up all the principal and all the interest. By doing this way, you are going to need much lesser amount compared to a whole lot of FD. And to do this, for the first 3 years, you will need FD kind of funds. For next 3-4 years, you will need some hybrid funds. And for last years, above 7-10 years, as Ramesh said, equities or equity-based funds.
No, what Dr. Raj Ramesh he is trying to say is at 65 itself, he will put into all three.
Yes, he is
He'll
right.
put into FD. He'll put 40 into FD, 40 into hybrid, 40 into equity. So basically, he's saying majority in equity because hybrid also has equity, 50% equity,
Ah,
50% debt, right? So he's saying
so
50% debt. Yeah.
yeah, I got the question now properly. This graph, this table shows that you are breaking it sequentially as we go on to next years. No, actually the graph should be, these four things are broken at 68 years only. So I would redraw this table as Ramesh is saying. This should look like this.
Yeah.
That's a good, remarkable correction, Ramesh. So yeah, he's right. When I showed the graph, I meant this as my breakup. So you'll break into,
Yeah.
let us say, 40 lakhs each. First 40 will sit for 3 years. Next 40 will sit for 6 years. Next 40 will sit for 10 years. And the last 40 will sit for 12 years. But you will essentially start eating them up from here. This is the point you will start consuming that investment, not
So
starting.
can we give this example of this reverse loan? Imagine a bank giving you a loan for your home. Initial years, all your amount EMI that you're paying is going for the interest of the bank, not your principal amount. As the
Correct.
years progress, then only you will be actually paying for your house. The initial all the years is for the interest that you're paying. You're paying for the bank, the EMI, the whole thing is going for the interest. Once you have finished all those interests, then you will be starting. So the home was never yours in the first place. Imagine this as a loan reversal. Is this? I think this is fairly okay to understand in that way.
Yeah. Correct, Raju. I totally agree with you. Correct. So, in loan reversal, you are eating up both principal as well as the interest. rather than FD, where you eat up only the interest rate.
Yeah.
Yeah.
Yeah,
So
done.
coming back to the main sheet. So this is a 4 basket model. Over to you, Raju. So we can see that with 1.5 crores only, we are able to maintain till 90 years of life, and that too with increasing pension 1.2 lakhs, 2 lakhs, up to 3.5 lakhs.
See, this increasing pension, this is not been mentioned just to as a eye candy or to say you're getting more money. This is assuming that there is inflation, assuming that you have better needs, you have higher needs as the age goes, as the age progresses. It is not to say, oh, you're getting so much amount. That is not the reason why it is being shown like that. It is to
Correct.
say that please consider inflation and yeah.
Satish,
Fantastic. So,
Small doubt.
tell me, sir.
Why can't you make 4 boxes at the age of 60 only, and just immediately after the retirement, so that we will get more returns? Then at the age of 68,
We are, we are assuming that the
I
person
agree
has
with you,
started
sir.
late.
that for first 80 years, why are not investing in 4 boxes?
Okay. So coming to the question here, why we have taken 68 years here and not 60 here, correct, sir?
Yes.
So this can be advanced to 50 years also, sir, depending on how much time you have got and how much money you want to create. Suppose I am in my 25s, I can create this corpus by 45 only, and I can continue to add to the corpus until I stop working at 65. And that will be even better corpus than this corpus. In this example, we have considered the boy starts at 38 years. Here, Raj is Raju.
Started very late.
Sorry, Raju?
Sir, no, I'm saying this person has started very late.
Yeah. So he has
So
started
that
38
it
years.
has gone.
He has started 38 years and he is now left 30 years. And the only way to reach this 1.7 crores is he has a very nominal amount to save here. If you increase the saving amount here, you can reach this corpus before 68, in fact 60,
Slightly earlier. Yeah.
in fact 50 also. And once you reach that a corpus by 60 years, you can still keep adding to it until you stop working. In this example, we took 38 years as a starting time and we took as retirement age as 68 years, and we assume that he is a very meagerly earning person at 55,000 or 60,000 something. So that's why we took 3,000 per month saving. 50,000 లోని 5,000 సేవ్ చేయాలంటే 10% అని కొంచెం బిగ్ అమౌంట్. I hope I
Yes.
answered your question, sir.
So 30 years is the saving time. 30, he started at 38, and 30 years is his saving time.
Correct.
That means
Correct.
68 is the cutoff point.
Correct. We're taking 68. We can do it
Okay.
earlier also, but you have to invest slightly more amount here. Let us say the same person wants to retire by 60 years. So he will have 22 years to retire. Then
The
the
amount will increase.
per
Monthly
month,
amount will increase.
yeah, per month thing goes up 10,000 almost.
Okay.
Yeah. So over to you, Raju. So
Yes.
I
Go
hope
back to the page.
this table is done well.
Yeah, yeah. So the understanding is basket one is not only basket one for the first 3 years. It's basket one, two, three, four all together, but basket one only for a small period, basket two for slightly more longer period, basket three for a much longer, and basket four for the final thing. So yeah, like we said, if you are putting the entire money in FD, that's very less amount of interest that you get. And for a person, if you have this much in your basket, like we are saying about the investing part, your debt bar, hybrid, and equity, then it will be around 1 lakh plus per month. So coming to like if it is safety, you require safety, one of your prime requirements. So next slide. And you should have growth. That is when you can achieve peaceful retirement, which is what we want to convey. So all we want to say is smart allocation, low risk plus high term. You can ask me how, Raju, will you say low risk? The longer the duration from the time you started investing, the lesser the risk. Initial 5 years, it will be high risk because you will not see any returns and you will be very anxious that there's no returns. But as the years pass by from the time you've invested, the risk becomes, like Sir has told, it is almost zero.
So yeah, so risk in 10 years is almost negligible. So that's why by smart allocation, we can have a happy retirement life. And that's the genius part of Raju innovation. The Raj here in this comic book is our Raju only. He has planned like a genius how to utilize the maximum of your diamond corpus to get the highest returns at a lowest risk and with the lowest corpus. So thank you so very much, Raju. Thank you so very much for that fantastic session. We are very happy
Thank,
that you took out your time despite
thank you
busy
for giving me the opportunity.
Despite the busy Pneumoviz and PICO conference coming up, I encourage everybody to register for this Pneumoviz, one of the most happening sessions this month end. The links are shared. Make the payments first, then contact Raju. He will send you a link. So the bottom line here is 1.5 crores is all that you need to get 1 lakh pension. Simple as that. So I'll put it again. 1.5 crore is all that you require today, as on today. If you want to retire today, if you have 1.5 crores, you will get 1 to 1.25 lakhs every month for the rest of your life on the increasing basis. As you can see in the table, 1 lakh, 2 lakhs, 3 lakhs. As the inflation goes up, if you survive till 90 also, you can have enough money to survive. So that's the fantastic presentation from Dr. Murli Mohan. Let's start early with the small amounts. And once you build the corpus, invest smartly, preserve smartly to make the best of your retirement life. I thank all of us for joining us. Now the bonus session, which people are waiting possibly, the 2 best funds this quarter to invest for the 2 best quarters to invest for this quarter, which are absolutely outperforming, and we'll try to look at what is the possible returns and what is the possible risk involved in these indices and why are we doing that. So this is a heat map again, where we can see the undervalued sectors and the expensive sectors. Just to let you know, people have been constantly asking me, Satish, can I invest in PSU Bank? They are rallying like anything. Or the PSC sectors, Central Public Sector Enterprises, PSE sectors. This is a sector which people are talking about. PSC, both are currently very expensive. If you have heard my session in Jan 2025 in the Great Pedicon Hyderabad, we told that it's a bad time to invest into these sectors, and accordingly the market crashed and people had booked 25% losses by investing in expensive sectors. I wouldn't recommend people to invest in expensive sectors. Rather, we have several more economic sector, highly discounted sectors which are currently undervalued. One such favorite sector of mine today we are going to discuss is export and service sector. One of the most fantastic sectors to invest into. If you look at the valuation of this sector, 50 rupees fair value అయితే కనుక currently 11 rupees దొరుకుతుందండి. 50% discount in this sector. Why it is like this? Because the service sector and export sector had been beaten up badly by the Trump's new laws, new regulations. Dear friends, please put in the group if I am repeating my sector. I don't think I have mentioned about export and service sector, but if I'm repeating that, please say repeat in the chat box. So export sector and service sector, they mainly focus on the non-manufacturing sectors. So you have two broad sectors, manufacturing sector and service sector. The IT companies, the banking sectors, all these service-based and consultancy-based companies come under service sector. So your TCS, IT, tech, media, everything is comes in the service sector. So if you come here, auto is manufacturing, chemical is manufacturing, FMCG is manufacturing, health is service, partially service, tech is service, media is service, metal is manufacturing, pharma is manufacturing, PSU banks, private banks are service sector, real estate is manufacturing, consumption is manufacturing, oil and gas, everything is manufacturing. Fin service again, I hope you can see my arrow, fin service again, service sector. So among these two broad classification, manufacturing and service sector, people somehow are investing in manufacturing at this point of time. It is slightly overvalued, 10-20%. Rather go for service sector. My dear friends, the all 12,000 funds in the mutual fund market can be categorized into these 120 groups. Currently, the service sector and export sector, India exports mainly the consultancies and services rather than manufactured goods. These are currently undervalued. So you can go home, click on service sector. You have one or two funds, only one or two funds, which are currently undervalued. I would like to take you across this. What is this service sector? This is that fund which is currently falling into exports and service sector. The fund has given remarkable returns over the period of time. Lot of returns the fund has given. Most importantly, the fund has, okay, let me come to this main page. So sorry. One thing I would show you, what does the portfolio constitute? What is the current PE ratio? Why we are recommending this? So before I finish this, I'll just walk you through this. The potential upside you're looking is 30% per year. A very reasonable risk of 45% compared to 70% risk in these overvalued hot sectors. In the worst case, you are looking at a potential loss of 6% in next 4 years. Hardly any loss from this point of time. So service sector, just to let you know, this is our website where behind this return, there is a potential very intelligent algorithm that predicts the future, not the past 5 years CAGR. This is the future 3 years potential probable returns in service sector. The worst case possibility, you may be looking at 6% loss from the principal. The best case possibility, the average case possibility, you're looking at 30% per year. And the best case will be around 120% in 3 years, approximately 40-50% per year. So, service sector mein one fund is this. Now coming to what does this fund constitute of? We are not promoting any specific thing here, but this one fund needs some special mention. So far the fund has given some 15-18% return since inception. The risk is around 20%. Allocations predominantly into large cap, less into mid cap, very small into small cap. So very safe asset class in this turbulent market also. Most importantly, if you look at the portfolio, they are mostly investing into banking and IT services. Pharma, you have both manufacturing and service sector. This is service sector pharma, the drug distribution, drug testing, all these kinds of companies, and insurance sectors. These sectors constitute the export sector. We export lot of manufacturing goods. So just my dear friends, this is not only exclusive service sector, it's export come service sector. Currently, the portfolio PE is sitting somewhere at an average of 32. Normally, the PE of this sector sits at 50 to 60. This is a reasonably undervalued for this fund and sector. So India exports pharma, IT, insurance, refineries, all these things. Among these, highest service we give is banking and financial services. This sector constitutes large cap service and export sector. You can see the predominant holdings in this company, which are mainly holding the top 50% of the company. Why I'm showing you this is because it's mainly in large cap, it's very safe in turbulent, and because it is highly undervalued, the risk involved is fairly low, and the worst case possibility is even better. So keeping all these 3 points in mind, the one fund I would choose for this quarter to invest for at least 3 to 7 years with rebalancing every 2-3 years. This sector constitutes one of the most fantastic funds. Just to let you know, we invested in this fund in March 2025. And just to let you know, I would be happy to show the results, how they are doing right now. Okay.
Somebody asked what is the net asset value of this fund. It is somewhere around 178, if I'm not wrong.
NAV, yeah. So you can see we bought at March 3rd this year, as you can see here, and we are already sitting at 15% returns. My dear friends, please understand, investing at the right point of time, a good lump sum in the right fund for a right duration. This is the complete prescription for investing. So, is it the right time for this fund? Yes. Is this the good fund among the 12,000 funds to invest in this quarter? Yes. This fund falls in the top 10% of the 12,000 funds. And what is the right time frame to invest for this fund? The right time frame is anywhere above 5 to 10 years. But this fund requires rebalancing every 2 to 3 years because it is very vulnerable to global pressures and global macroeconomic changes. Please consult your advisor to rebalance every 2-3 years. You can't just invest lump sum and sleep on this fund. It has to be reviewed every 2-3 years. So that's the complete prescription for this fund. Right fund, right time, the right amount, and the right time frame we have discussed. And the right mix, as I'm considering, we have to choose a basket of 8 to 9 funds. That will make a good basket. In the past 2 sessions, I have mentioned the 2 or 3 funds. This is the 4th or 5th fund. My dear friends, I would like to repeat again and again that this June is the last best opportunity for next 2.5-3 years for investing any big chunk into the market. Small SIPs, people who can't invest long, continue SIPs and start from now. But people who are investing to improve the strategy by SIP plus lump sum, the smart SIP, then this is the time before this June 30. Thank you so much for patient listening. I would be very happy for any questions in this session. We are already 10:35, 12 minutes late into the session.
Sir, if somebody has a doubt saying that the ICICI, apne, whatever fund you have shown, the service and export thing, the expense ratio is high for this. It is
Expense
1.6 sitting. It's high. It's 1.6. If somebody has like a commoner like me
1.6,
who has doesn't, yeah, somebody who has very little knowledge in judging, somebody somewhere we have heard that expense ratio should be less than 1. In this situation, it is more than whatever it is. Please explain.
So I would like to address this question. Now I told in one of my previous sessions, म्यूचुअल फंड सही है, इंडेक्स फंड बढ़िया है. I won't say index funds are the only funds left over. Okay, so I am a proactive promoter of index funds. Again, I would like to repeat, there was a big study done. My great mentor Warren Buffett and Jack C. Bogle, they have established this beyond proof that for a long-term investor, without touching or rebalancing, assuming the costs are beyond 2.5% in active funds, beyond 2.5% active funds, index funds make a good choice. Now, what is a low expense ratio? What is a good expense ratio? What is a bad expense ratio? Before I answer this question, please, as per your understanding, put up in the chat box what is a good expense ratio. I'll give you options: 0 to 0.5%, 0%, absolutely zero expense ratio, 0 to 0.5%, 0.6 to 1.3%, 1.3 to 2.5%, and about 2.5%. Can somebody tell me? I would show my screen and ask you what is a good expense ratio. So first category is 0.0%. Next is 0.6 to 1.3%. Next is 1.4 to 2%. Next is 2.5 to 3.5%. So which is the best expense ratio to start? This is one very good question I always want to ask. Thankfully, somebody asked this question. 1.3 to 2.5%. Ojha sir, namaskar. Our Ojha sir has joined us from our great city of Prayagraj. He is an ardent, enthusiastic person who is constantly following our financial literacy. Namaskar, Bimal sir. Bimal sir is from Orissa. He is such a fantastic enthusiast.
Good evening, sir.
Good evening, sir. Namaskar, namaskar, sir. And Bimal sir is such a finance enthusiast that for a personal learning, he traveled from Cuttack morning 4 o'clock and arrived at 1 o'clock in Vizag for a one whole day session of learning. Mera koti koti abhinandan, Bimal sir. Thank you for joining our session now. And that's answer is 0.6 to 1.3%. Anybody else? What is the best expense ratio for a mutual fund? And what's the proof for that? So 0.1 to 0.3%, 0.6 to 1.3%, 1.4 to 2%, 2.5 to 3.5%. So my dear friends, सबसे पहले claps for both Ojha sir and Bimal sir. Please give a big hand. Despite being quite senior in their practice, they spend enough time on learning, and that's the best learning they have got. Thank you so much, sir. The right answer is the bad expense ratios are very low or very high. Good ones are optimal expense ratios. Why we say this, I will come to this explanation. Imagine this, you have two funds. One is a small mutual fund, let us say Bandhan Bank recently opened a mutual fund house. They have got only 20 crores ka AUM in their fund. And there is one person who is managing a portfolio of 20,000 crores. Now, these two fund managers, the B, big fund manager, the C, the small fund manager. So, big fund manager has got 10 lakh investors into his portfolio, whereas the small fund manager has got only 100 investors in his portfolio. Now a catastrophe struck in the market. The prices crashed to discounted price. Both the fund managers run to buy things in the market. But what happens? Panic. The small fund managers investors stopped the SIP and withdrew their money. Whereas big fund manager has got 10 lakh investors. No, even if 10,000 investors stop it, he still has enough money to buy the stocks at lower price. Now tell me, who will have better returns? The big one or the small one? Basically, fund managers always try to buy low, just like everybody else. We also want to buy low. They want to buy low. But small investor pool creates quite a volatility in their AUM. They have quite difficulty managing their fund and getting good returns. So my question is very simple. In a turbulent time, who will have better returns? Big one or small one? The big one or small one?
Smaller returns will be by the smaller group.
Correct. Fantastic. Krishna, Banga Krishna sir, fantastic answer. Banga Krishna sir is one of my most favorite investor and education enthusiast. He always attends. Any education, he always attends that. So the answer is absolutely right. The big one will have better returns. So now tell me, my dear friends, how do you think I can make my small AUM into big one? The best thing to do is do lot of marketing events, investors meets. You have to spend some amount of money, at least 1% you have to spend on your marketing. Just like a great doctor sits empty handed in his clinic. Why? Because he has not done enough marketing. You have to spend, as a doctor, 5-10% of your time, money, energy on marketing, or marketing yourself. Similarly, a fund house has to spend some money on marketing and bring investor awareness. And that brings the cost to nearly 1%. Without 1% expense and having a very small AUM, very badly hampers your performance. So these funds, which have got a very little expense ratio, they usually end up having a very small AUM, and they usually end up performing miserably on return chart. So after doing all the study for the past 120 years in America and the whole globe, they realized that optimal expense ratio for maintaining an optimal return that is optimally expected from that fund, you need to spend at least 1% on managing the fund, promoting the fund, and bringing awareness about that fund. And that brings us to answer. The expense ratio is 1 to 1.5% is the optimal expense ratio. Anything beyond 2%, 2.5%, I would also say no. Anything less than 0.5%, I would strongly say no. Anything around 1% is an optimal expense ratio. Always remember, very low expense ratio, very high expense ratio are both bad for returns. 1 to 1.5% is a great expense ratio. So I hope that answers the question asked by our friend, that what's a good expense ratio? The good expense ratio is 1 to 1.5%. Any other questions? Somebody has asked me, what were the previous two good funds we discussed? So the last time I told about small cap, momentum, quality, Nifty small cap 250, momentum, quality 100 index fund, FOF, fund of funds. So despite being an index fund, the expense ratio sits around 1 to 1.5%, but that has given exceptional returns in the past 3 months. We got almost 23% in the past 3 months. Right time, right fund, right risk. Coming to other funds, sir, are index funds superior to equity funds? So this question, I would not make it general, I would make it specific. So if you are looking at 10 years and above, the great $1 million bet, proved that beyond 10 years and above, index funds are better. They have 1% higher returns. Second question, so when you ask whether index funds are better or not, you must also tell me what is the time frame, what is the expense ratio of equity fund you're talking about, and what is the rebalancing options available for you. So I would like to add this point here. If you have got more than 10 years, yes, index funds outperforms by at least 2% margin as the study revealed. Okay. Coming to less than 5 years, less than 3 years, active funds have significantly outperformed. In a time frame of 3 to 5 years, more than 60 to 70% funds have outperformed the index funds. If your time frame is 3 to 5 years, I would not recommend index funds as the first option. Coming to expense ratio, we believe that in the study they conducted, the assumed index fund expense ratio was 0.4% versus the active fund was in those studies 2.5% and above. In this comparison, index funds are better. But if your active funds have got an expense ratio of 1 to 1.5%, it doesn't create much of an edge for index fund or active fund. So in this optimal horizon, you are good with both. Most small cap funds, most large cap funds sit at 1 to 1.5 expense ratio. Third question is, sir, I am a dumb, know nothing investor. I will invest and sleep like Kumbhakarna. Then no brainer option, then index is the best for you. But remember, no rebalance, funds have given 12%. With rebalance, funds have given 18%. And that's a staggeringly higher return. Why do I say this? We know that every fund in the first 5 years gives the highest returns if you start at the right time. For example, if you start now, for the next 3 to 4 years, funds may give 20-30%. So how it happens is, if you begin at the right time, in 5 years span of time, you may see 20 to 30% returns. But as you go forward to 10 years, then dilution starts and you end up in 13%. That's why most funds will show you returns of 13% or at the best 15%. So what we recommend investors is rebalance your portfolio in 3 to 5 years, capitalize all your profits and switch to the next undervalued sector. In that way, you can crack 18 to 20% with the same small cap funds or momentum funds or whatever good funds are there. So the answer question is, if you are talking about index fund for a know-nothing investor, dumb person, no rebalancing versus a expense ratio, high expense ratio fund, index are better. But if you have option of time frame less than 3 to 5 years, if you have option of expense ratio 1 to 1.5%, if you have rebalancing options every 3 to 5 years, I would say active funds do significantly higher than index funds. I hope.
So there's one more question. Sir, మనం NAV తక్కువ ఉన్నప్పుడు ఫండ్స్ బై చేయాలా?
One of my favorite questions. Others are leaving. So before others are leave, I will thank everybody heartfully for joining the session. I will thank our Murli Mohan sir. I will thank our fantastic, remarkable Raju for making the session successful one. Just to let you know, Raju is the one helping us with the big platform of Zoom, which can accommodate more than 100 people also. So Raju said, because it's education session, sir, we should go with the bigger platform. So he's providing us a sponsored premium version of Zoom session. So thank you so much, Raju. Thank you so much from my side also. I will answer the questions Why others are leaving? I'll just take 5 minutes more. So NAV తక్కువ అంటే బెటరా ఎక్కువ అంటే బెటరా? చాలా సింపుల్ క్వశ్చన్ అండి. ఒక ఎక్సెల్ షీట్ చూపిస్తాను చూడండి మీకు. స్టాక్ ప్రైస్ తక్కువ ఉంటే బెటరా ఎక్కువ ఉంటే బెటరా? We actually did one study on penny nuts versus expensive rockets. Our idea was very simple. You buy the cheapest stocks in the market, or you buy the most expensive rockets or the most expensive NAV funds and compare them across 40 years. What happens? And we have published paper for that. I'll show you next time. It was shown that expensive rockets do better compared to the penny nuts. Now coming to the point, why low NAV doesn't help or why expensive NAV doesn't matter. In case of funds, NAVs have absolutely nothing in our decision making. Why? Very simple. Take a small example. You have a 1,000 rupee fund and you have a 10,000 rupee fund. The total AUM is 1,000 crores and 10,000 crores. Or you can say 100 rupees or 10 rupees NAV versus 100 crore or 1,000 crore ka fund. This is 10 crore AUM and NAV now is 10 rupees. Same fund starting same today, the NAV is 1,000 rupees. If both funds perform well and they become very simple 20 rupees and 2,000 crore company, the NAVs will grow from 20 rupees to 2,000 for you also. The profit is same for both the people. It depends on the growth of the fund house or the fund. If you have a blue chip fund versus same blue chip fund with lower NAV, it won't matter. It's just like having 10 rupees, 10 1 rupee coins in our pocket or having one 10 rupee note. Both mean the same, no? When your salary increases, 10 will become 20, 1 will become 2, 100 will become 200. The profits in your portfolio will be same. NAV doesn't matter. It's just the number of units that you break it into. I hope I answered the question.
Yeah.
So thank you so very much, my dear friends. I think that's 11 o'clock in the night and people have fantastically given support to us. Thank you so much, Bimal sir. Thank you so much, Oja sir. Thank you so much, Banga Krishna sir. And thank you so much for all other people who joined our session today.
Thank you.
Thank you so very much. Have a lovely night.
Satish, sir, today the number of participants are 60. Today we have reached 60.
Yes,
The
yes.
recording has stopped.
So
Okay, then
we'll quit now.
Yes, Satish and Raju.
Yeah. Yes, sir. Murli Mohan sir, Oja sir. Good night, sir. Good night,
Good night,
sir.
sir.
Murli Mohan, sir. Thank
Good
you
night,
so
sir.
very much,
Have a good
Murli Mohan, sir. Thank you so very much. I hope the session was good today, sir.
Yeah. Fine.
Thank you so much, sir.
Thank
you
you,
so
sir.
much.
Thank you, sir.
Have
Thank
a
you,
lovely
sir.
night, dear friends. Have a lovely night.